On July 14th, the big news is IBM's 25% single-day crash. This isn't just about one company. It shows a major squeeze in enterprise IT spending as buyers pivot to cover rising hardware costs and security demands. The trigger was IBM's preliminary Q2 update. Software revenue growth slowed from 10% to 5%, and overall revenue rose only 1%. When growth for a tech giant drops like this, it makes the market ask what other software budgets are being cut. A big reason for this slowdown is that clients are front-running price increases in memory and storage. They are accelerating their hardware purchases to secure supply before prices jump, which left IBM's infrastructure revenue down 7% this quarter. Budgets are also shifting towards security. Reports from analysts like Unrivaled Investing point to Anthropic's Claude Mythos model, which has highlighted serious software vulnerabilities. Enterprise clients are diverting funds to defensive security measures to protect their systems. This shift aligns with broader trends in AI capital spending. Projections for 2026 suggest AI Capex could reach $800 billion, or 2.5% of US GDP. Such concentration is typical of historical investment cycles, and it increases the risk of sharp pullbacks. While technology budgets are tightening, the macro picture got a boost. The June CPI fell 0.4% month-on-month, the largest drop since 2020. This disinflation signal temporarily eases pressure on the Federal Reserve to raise rates. However, inflation relief might be short-lived. Geopolitical tensions have flared up in the Strait of Hormuz, with reports of cargo transit tax proposals and military threats. This immediately explains today's early session volatility. Energy exporters are already hedging against these transit risks. Saudi Arabia and the UAE are accelerating bypass corridor projects to route oil around the Strait of Hormuz entirely, aiming to secure up to 14 million barrels per day of bypass capacity. Back in the US, software valuations are adjusting. Intuit is trading at 16 times earnings after a 65% drop over the past year. Even though management is pitching an AI growth acceleration, the market is pricing in near-term headwinds. In contrast, defensive industrial sectors remain steady. Construction Partners, a road maintenance consolidator, is using a roll-up acquisition model to target $6 billion in revenue by 2030, showing double-digit growth. We also saw a cluster of dividend increases in July across industrials, energy, and transportation, including Fastenal and Ryder. These hikes suggest corporate boards remain confident in their cash flows, despite broader valuation concerns. For investors looking for income, the exchange-traded fund space is evolving. Products like QQQI are using covered call spreads to capture NASDAQ upside while paying a 14% yield, offering a different way to manage equity exposure. So here's the outlook. IBM's crash shows that enterprise software budgets are under pressure from hardware front-running and security costs. When you pair that with CPI volatility and geopolitical energy taxes, it makes for a complex tape.